I want you to start by picturing a world's map. Just hold it in your mind's eye for a second.
Okay.
Now, bypass the vast expanses of the Pacific and the Atlantic and zoom right in on the Middle East. Look for this tiny, narrow waterway right between the Persian Gulf and the Gulf of Oman.
Right, the Strait of Hormuz.
Exactly. If you're looking at a standard globe, it is barely a geographical blip. I mean, at its narrowest point, it's only about 21 miles wide. And the actual navigable shipping lanes, the ones that accommodate those massive deep-water vessels, are just 2 miles wide in either direction.
Yeah, 2 miles. It's nothing.
Right. It looks like nothing more than a minor pinch point on the map. But I want you to imagine that this specific, tiny stretch of water holds the absolute power to dictate, well, the baseline cost of your groceries this weekend, or the exact purchasing power of the money sitting in your bank account right now.
Oh, absolutely.
And even whether your country's entire economy is about to just tip over the edge into a severe recession.
It is a phenomenal visualization, honestly, because the contrast between its physical dimensions and its gravitational pull on global macroeconomics is just truly staggering.
Yeah.
When you actually look at the logistics, you're talking about roughly 20 million barrels of oil moving through that 2-mile wide lane every single day.
20 million.
20 million every day. Plus, you're talking about roughly a quarter of all global liquefied natural gas trade. I mean, it is the definition of a choke point.
Oh.
And not just in a military or geographical sense, right? It is the central node in the entire global pricing system.
And that is exactly what we are mapping out in today's deep dive. We are looking at a massive structural macroeconomic regime shift. And I want to set the parameters right up front for you listening. We are not just talking about geopolitics today.
No, not at all.
We aren't looking at energy prices in some sort of academic vacuum.
Yeah.
And we aren't just rehashing standard commodity cycles. We are tracking a highly specific, fundamentally unstoppable chain reaction.
Right.
It goes like this. A supply shock in that narrow waterway triggers an asymmetric oil spike. Then that oil spike unleashes a very specific, virulent strain of inflation.
Yeah, the sticky kind.
Exactly. And then that inflation forces a draconian reaction in global interest rates. Those interest rates act as a wrecking ball in foreign exchange markets. And finally, that foreign exchange chaos ultimately creates massive, systemic, global liquidity stress.
And what is really critical to understand about that exact chain reaction is that the shock absorbers that used to exist in the global financial system, they're entirely gone.
Gone.
Completely.
Yeah.
I mean, if you go back 10 or 15 years, those dominoes you just laid out, they were spaced far enough apart that one falling didn't inevitably knock over the rest.
So the system could take a hit.
Right. A geopolitical event might spike oil, but it wouldn't necessarily trigger an emerging market sovereign debt crisis, or force the Federal Reserve into a total corner. But the institutional plumbing has fundamentally changed. The spacing between the dominoes has basically been eliminated. The system is operating without any slack.
Which is exactly why we really need to dig into the actual mechanics of this. I mean, you spend your life looking at these macro strategies, right? Dissecting the institutional plumbing and connecting these global dots.
That's right, yeah.
So I'm going to push you on how this actually plays out in the real world today. Because for you listening, here is the promise we are making. By the time we finish mapping this out, you're going to be able to look at a simple, mundane news headline about a shipping delay in the Middle East, and you will instantly understand the hidden, complex web of global finance that it just triggered.
You'll see the matrix behind the headline, basically.
Yeah, I'll see the matrix.
And honestly, it's the only way to operate in the current environment. Understanding that plumbing is no longer just this intellectual exercise for fixed income traders or energy analysts. I mean, it is the prerequisite for understanding asset allocation, business planning, just capital preservation in general.
Okay, so let's start with that physical choke point we visualized, the Strait of Hormuz. We need to ground this in the baseline reality. You mentioned 20% of global oil consumption passes through there.
Yep. And for certain Asian economies, their dependency on that specific strait for their daily energy needs pushes past 70 or even 80%.
See, I think a lot of people assume that if a choke point gets congested or shut down, the market will just, find an alternative route. Like that's how capitalism works, right?
I think so, yeah.
We just build a pipeline. Or we reroute the ships around the Cape of Good Hope. I mean, we saw supply chains adapt during the pandemic when ports were backed up.
Yeah.
So is the physical dependency on Hormuz really an unsolvable problem?
Well, The scale of the physical infrastructure required to bypass it makes it effectively unsolvable in the short to medium term. I mean, yes, alternatives technically exist. Saudi Arabia and the UAE have pipeline networks that bypass the strait.
Right, to reach the Red Sea or the Gulf of Oman.
Exactly. But those pipelines have a maximum working capacity, and they are already heavily utilized. I mean, they could perhaps offset a few million barrels a day under optimal conditions, but you cannot offset 20 million barrels a day.
It's just physically impossible.
Physically impossible.
Yeah.
The physical shipping fleet, the terminal infrastructure, the deep water ports required to handle that volume, you just can't magically reroute it overnight. And it's not just crude oil, right? The LNG infrastructure is even more rigid.
Liquid natural gas.
Right. You can't just put LNG on a standard cargo ship. It requires highly specialized, multi-billion-dollar vessels and these massive cryogenic export terminals.
Okay, so I want to look at how the market actually prices that kind of physical rigidity, because it brings me to an analogy I've been thinking about a lot lately. I keep thinking about the great toilet paper panic of 2020.
Oh, yeah. That's a great example.
Right. During those first few weeks of the pandemic, there wasn't actually a fundamental catastrophic failure in the paper manufacturing supply chain.
No, the factories were fine.
The factories in Wisconsin and everywhere else, they were still churning out toilet paper. But the mere fear that there might be disruption caused consumers to rush out and hoard it. Everyone bought 6 months' worth of inventory in a single day.
Yeah.
Which, ironically, created the exact catastrophic shortage everyone was afraid of in the first place. So looking at the oil market in this Hormuz choke point, is it driven by that same psychology? Does the fear of a shortage create the actual crisis before a single tanker is even physically blocked?
Oh, the psychology is identical. Absolutely identical. But the institutional scale makes it vastly more dangerous. What you're describing with the toilet paper is a panic-driven inventory drawdown. And in the oil market, that behavior is amplified by the mathematical concept of inelasticity.
Inelasticity. Break that down for us.
Sure. So in a normal market, if the price of something goes up, people buy less of it, right? Or producers make more of it to capture the higher margin. That's elasticity. But energy is highly inelastic on both the supply and demand sides.
Because, I mean, if you're a logistics company moving freight across the country, or an airline, or a municipal power grid, you can't just decide not to consume energy today because the price jumped.
Exactly.
You have to buy it to keep the lights on and the trucks moving. Your demand is incredibly sticky.
Precisely. The demand doesn't drop off immediately. You can't just turn off the economy. And on the supply side, the situation is actually even more constrained right now. Over the last decade, we have witnessed this historic, systemic underinvestment in global oil infrastructure.
Why is that?
Well, following the oil price crash in 2014, capital expenditure in the upstream energy sector was totally decimated. Companies just stopped spending money finding new oil. Then you had the rise of ESG mandates.
Right. Environmental, social, and governance.
Exactly. Which effectively restricted institutional capital from flowing into fossil fuel exploration at all.
Yeah.
And even in the U.S. shale patch, the business model shifted. It used to be drill at all costs, but it shifted to capital discipline returning cash to shareholders instead of investing in new rigs.
So we've essentially spent 10 years eating into our seed corn, so to speak. We haven't been building the new deepwater wells or the new refinery capacity required to maintain a cushion.
Exactly. And because of that sustained capital starvation, the global market essentially has zero spare capacity left.
Zero.
Functionally zero. And spare capacity is the ultimate macro shock absorber. Historically, if a geopolitical event in West Africa or South America took 1 million barrels off the market, Saudi Arabia or the UAE could just turn a few valves, tap into their spare capacity, and flood the market with enough extra crude to stabilize the price.
And the market knew that safety net existed.
Right. The market priced in the safety net. But you're saying that safety net is gone. The geopolitical environment is heating up precisely at the moment when the physical market is at its tightest.
Wow.
It is entirely tapped out. So now, because supply is perfectly inelastic in the short term, a 1% drop in global oil supply does not correlate to a 1% rise in the price of oil.
It's exponential.
It's massively asymmetric. Without those shock absorbers, a tiny drop in physical supply, or even just the credible threat of a drop, creates an absolutely massive price spike. The price doesn't go up 1%. It might go up 20, 30, or 40%.
Just to force people to stop buying it.
Exactly. simply because the only way to balance the market is to drive the price so high that it literally forces demand destruction. It forces businesses to shut down because they can no longer afford the energy input costs.
And tying that back to the hoarding psychology, if you are a sovereign nation heavily dependent on imported energy, like Japan or South Korea, or if you're a massive industrial conglomerate, you know this dynamic. You know there's no spare capacity.
Yeah, they see the writing on the wall.
So the second tensions flare near Hormuz, you don't wait to see if a ship actually gets sunk. You immediately step into the physical market and buy every barrel you can get your hands on to secure your own strategic reserves.
Yes. That aggressive, preemptive stockpiling draws down whatever marginal global inventories are left, which aggressively bids up the spot price. The market psychology just becomes a self-fulfilling prophecy. And, this highlights a really profound shift in how the market evaluates risk today.
How so?
Well, for decades, a major disruption in the Strait of Hormuz was categorized as a tail risk.
Meaning an event that sits at the extreme tail end of a probability distribution curve. High impact, but incredibly low probability.
All right.
The kind of thing risk managers stress test for maybe once a year, but they don't actively trade around on a random Tuesday.
Right. It was treated as a black swan event.
Yeah.
But today, because the system has zero elasticity and geopolitical fragmentation is just accelerating everywhere, that tail risk has morphed into a structural risk. It has been integrated into the baseline geometry of the market. Traders are no longer treating a Middle East supply shock as a hypothetical what if. They are pricing it as an ongoing, highly probable reality.
And we can see this structurally embedded in the auxiliary markets, right? Like, it's not just a theory. You look at the cost of shipping insurance premiums for vessels entering the Gulf, and they have surged to levels that drastically alter the economics of moving the cargo.
Oh, absolutely.
You look at forward freight agreements. Traders and insurers are embedding a massive geopolitical risk premium directly into the baseline operational cost of securing a barrel of oil.
Which means the floor price of oil has permanently shifted higher. The market is pricing in the fear of the choke point on a daily basis.
Okay, so that establishes the foundation of our chain reaction. The physical vulnerability of the choke point meets a market with zero spare capacity, resulting in a structural asymmetric price spike driven by preemptive hoarding and risk premiums.
Exactly.
But here is where we trace the first major transmission mechanism. Because once that baseline price of oil spikes, it doesn't stay quarantined in the energy markets. It bleeds into absolutely everything else. Which brings us to the first massive macroeconomic consequence: inflation.
Yeah, and if you want to understand the inflation regime we are operating in today, you have to recognize that oil sits at the absolute epicenter of the global pricing system. When energy prices rise, the transmission into the broader economy happens in two very distinct sequential waves.
All right, wave one.
The first wave is direct, immediate, and highly visible.
Right, this is the wave everyone feels intuitively. You pulled her to the gas station, and the price at the pump is up 30 cents. Airlines immediately hike ticket prices to cover their jet fuel costs. Logistics companies slap fuel surcharges on their delivery invoices.
Yep, it hits instantly.
Your municipal utility company files for a rate increase because the natural gas they burn to generate your electricity just doubled in price. All of these direct energy inputs feed instantly into the consumer price index. The headline CPI spikes almost in real time.
And that direct transmission is relatively straightforward for the market to digest. I mean, it hurts the consumer, but it's a known quantity. But the true danger lies in how the market and policymakers misinterpret what happens next.
Well, let's talk about that interpretation because I want to push back on the mechanics of this from a classical economic standpoint. Let's look at this purely through the lens of consumer demand.
Sure.
If I am suddenly forced to allocate a significantly larger percentage of my monthly income to putting gas in my car and heating my home, I inherently have less discretionary income.
Makes sense.
Right. I am not taking my family out to a restaurant on Friday night. I am delaying the purchase of a new laptop. I'm not buying new clothes. So across the entire economy, aggregate consumer demand plummets. And there's an old, deeply ingrained adage in commodity markets.
Yeah.
The cure for high prices is high prices.
Right, the classic saying.
Doesn't that massive structural drop in discretionary demand naturally cool the economy down and ultimately break the back of the inflation?
It's the logical assumption to make. And frankly, it is exactly how a generation of economists and central bankers were trained to think during the Great Moderation. The period of stable growth and low inflation we experienced from the 1990s up until recently. In a demand-driven economic cycle, your logic holds up perfectly. If an economy runs too hot, prices rise, demand destruction occurs, and prices mean revert. But that entire economic framework completely misdiagnoses the reality of the current regime.
Why does it fail?
That old logic fails because it ignores the second wave of inflation transmission.
Break down the mechanics of that second wave for me. Why does the demand destruction not cure the inflation?
Because the second wave is entirely supply-driven, and it embeds itself into the fundamental cost structure of the physical world. Oil and natural gas are not just the fuels that transport finished goods, they are the elemental building blocks of the goods themselves.
Okay, give me an example.
Let's look at the agricultural complex. When natural gas prices spike because of global energy tightness, it directly inflates the cost of producing anhydrous ammonia.
Which is used for fertilizer.
Exactly. The Haber-Bosch process, which synthesizes nitrogen fertilizer, is incredibly energy intensive. Natural gas represents the vast majority of the input cost for nitrogen fertilizer.
So the farmer in Brazil or Iowa isn't just paying more for the diesel to run his tractor. His actual chemical inputs to grow the crop have skyrocketed.
Exponentially. Which means the absolute floor price for corn, wheat, and soybeans shifts structurally higher. The cost of food production soars. Now, pivot to manufacturing. Look at the petrochemical industry. Plastics, synthetic rubbers, resins, industrial lubricants, pharmaceutical precursors, they're all derived directly from petroleum feedstocks.
Yeah.
When the price of oil spikes, the baseline manufacturing input costs across almost every sector of the industrial economy soar.
So even if consumer demand drops, even if I'm buying fewer laptops or fewer sneakers, the baseline capital required to physically manufacture, package, and transport the few items I do buy has permanently ratcheted up. The margin floor has moved.
Exactly. And this is where the economic math translates into human psychology. Businesses look at their supply chains. They look at their soaring input costs for raw materials, packaging, and logistics, and they realize their profit margins are just evaporating.
Right.
So what do? They don't wait to see if consumer demand will balance things out in 2 years. They preemptively raise the prices of their end products to protect their margins. They front-run the inflation.
Which triggers a reaction from the labor force. Because the everyday worker is looking at their utility bill, their grocery receipt, and the price of gas, and they realize their real inflation-adjusted wages are plummeting.
Yep. They are actively getting poorer every month.
So they leverage whatever power they have to demand higher wages from their employers just to maintain their baseline standard of living.
Which sparks the classic wage price spiral. When companies are forced to pay higher wages to retain their workforce, their internal operating costs go up yet again, which forces them to raise the prices of their goods and services a second time.
It's a vicious cycle.
It is. What started as a temporary, acute geopolitical supply shock in the Middle East has now metastasized into a permanent structural inflation virus that has infected every layer of the domestic economy. This is the crucial paradigm shift we have to grasp. The global economy has transitioned from a regime of the central banking establishment, whether it's the Federal Reserve, the European Central Bank, or the Bank of England, is fundamentally ill-equipped to handle this dynamic. They are basically trapped in a macroeconomic straitjacket.
How so?
Well, when inflation runs hot, central banks have a statutory mandate to bring it back down to their target, usually around 2%. But the only real tool they have to accomplish this is monetary policy, specifically manipulating short-term interest rates and adjusting the size of their balance sheet.
I want to really dig into the friction here, because I think a lot of people assume the Federal Reserve is omnipotent. But let me try an analogy to clarify the limitation of their tools.
Go for it.
Is applying monetary policy to a supply-driven oil shock, essentially like a surgeon prescribing aggressive chemotherapy to treat a broken leg.
I love that.
What I mean is, if the root cause of the inflation is a physical lack of crude oil flowing through a physical choke point in the Middle East, combined with a decade of underinvestment in physical refineries, how on earth does raising the interest rate on a 30-year home mortgage in Ohio fix that? Jerome Powell can hike the federal funds rate to 15%, but he cannot print a single barrel of light sweet crude, and he can't synthesize nitrogen fertilizer.
The chemotherapy analogy is devastatingly accurate because it highlights the collateral damage of using the wrong tool. Monetary policy is exclusively a demand-side instrument.
Right.
When a central bank hikes interest rates, they are raising the cost of capital across the entire economy. They make mortgages more expensive, which cools the housing market. They make corporate credit more expensive, which forces businesses to halt expansion and lay off workers.
They make auto loans more expensive, which slows manufacturing.
Exactly. They're deliberately tightening financial conditions to asphyxiate consumer and corporate demand.
They're essentially trying to engineer a recession to kill the inflation. But here's where I want to push back on the idea that they're totally powerless, because history gives us a very clear precedent. If we look back at the 1970s and early 80s, which was the ultimate era of supply-driven inflation caused by the Arab oil embargoes, Paul Volcker, the Fed chairman at the time, actually did solve it.
Did he, though?
Well, he aggressively hiked interest rates to nearly 20%. He crushed the economy, induced a brutal recession, but it broke the back of inflation and reset the system. Why can't today's central bankers just pull a Volcker? Why is that playbook obsolete?
It's an excellent question. And honestly, the Volcker myth is one of the most dangerous misunderstandings in modern finance. Everyone wants to point to Volcker as the ultimate inflation slayer. But the structural realities of the global economy in 1980 versus today are worlds apart.
What's the main difference?
The primary difference is the sheer magnitude of sovereign debt. When Volcker hiked rates to 20%, the U.S. debt-to-GDP ratio was roughly 30%. The government's balance sheet could easily absorb the higher interest expense on that debt.
And today?
Today, the U.S. debt-to-GDP ratio is over 120%, with over $34 trillion in outstanding national debt.
34 trillion.
Right. The global economy is exponentially more financialized and leveraged than it was in 1980. If the Federal Reserve attempted to hike rates to the levels necessary to truly crush supply-driven inflation today, say taking the Fed funds rate to 8, 9, or 10%, the interest expense on the U.S. national debt would consume the entire federal budget.
Wow.
You would trigger a sovereign debt crisis in the United States, collapse the global banking system, and precipitate a depression. They simply do not have the mathematical runway to execute the Volcker playbook.
So they are trapped. They have to hike rates enough to look like they're fighting inflation, but they can't hike them enough to actually kill a supply shock without imploding the treasury market.
Exactly.
That sounds like a complete policy disaster. Why wouldn't a central bank, recognizing this trap, simply choose to step back? Why not admit that monetary policy can't fix a geopolitical oil shortage, pause rate hikes, let the inflation run hot for a few years while supply chains reconfigure, and just save the underlying economy from a catastrophic engineered recession?
Because the alternative, stepping back and accommodating the inflation, triggers an even more destructive market reaction. This goes to the core psychology of fiat currency systems. The single most valuable asset any central bank possesses is not its gold reserves or its foreign exchange reserves. It is its credibility.
Credibility.
Yes. The market has to believe that the central bank is committed to preserving the purchasing power of the currency. If a central bank suddenly signals that it is tolerating high inflation, if they pivot to easing monetary policy while supply-driven inflation is still raging, they instantly lose that credibility.
And what are the mechanics of that loss of credibility? How does the market actually punish them?
The punishment is swift, and it happens in the bond market. If institutional investors, the bond vigilantes, believe that the central bank has surrendered to inflation, they know that the real return on their long-term bonds is going to be wiped out.
Because inflation eats the yield.
Right. So they aggressively dump government bonds. When bond prices crash, yields skyrocket. So long-term interest rates will organically explode higher on their own, driven entirely by the free market demanding an inflation premium, completely bypassing the central bank's control.
So the Fed loses control of the curve.
The yield curve steepens violently, volatility explodes, and you end up with the exact same tightening of financial conditions, but this time accompanied by a total loss of faith in the currency.
So to synthesize this brutal dilemma, if central banks stubbornly hike rates, they crush the domestic economy and risk a sovereign debt spiral to fight a physical supply problem they can't actually fix. But if they capitulate and ease up, inflation runs rampant, bond vigilantes take over, and they trigger a massive crisis of confidence in the currency itself. They are checkmated by the physical reality of the oil market.
Precisely. The central bank is forced into a posture of persistent structural tightness. They have to maintain restrictive rates far longer than the market anticipates, simply to prevent inflation expectations from unanchoring, even as the underlying economy cracks.
And that concept of the currency becoming the focal point of the crisis is the perfect bridge to the next major phase of this macroeconomic chain reaction. We've gone from the physical choke point to the asymmetric oil spike to the virulent supply-driven inflation into the central bank straitjacket.
Yep.
Now, as interest rates are forced higher in confidence waivers, we crash headfirst into the foreign exchange markets. Because when you analyze the transmission of an energy shock through the lens of currency, everything orbits around the absolute hegemony of the US dollar.
The foreign exchange market is where the localized pain of an energy shock is weaponized and exported globally. To understand this, you have to look at the foundational architecture of the global financial system established in the 1970s, the petrodollar system.
Right, the petrodollar.
Global commodities, and most importantly, crude oil, are almost exclusively invoiced and settled in US dollars. It doesn't matter if you are buying oil from Saudi Arabia, Norway, or Brazil, the transaction clears in dollars.
Which means that the price of oil and the value of the dollar are intrinsically mechanically linked.
Exactly. When the price of oil spikes due to our geopolitical choke point, it creates an immediate, structural, and massive surge in global demand for the US dollar.
I want to really slow down here and explore the mechanics of this from the perspective of an everyday listener or a business owner operating in an emerging market, say Turkey, Brazil, Sri Lanka, or Indonesia.
Okay, let's do that.
Because the petrodollar dynamic creates a highly asymmetric punishment for these countries. Walk me through the step-by-step institutional reality. If a country needs to import oil just to keep its electrical grid functioning, why are they suddenly subjected to a catastrophic double whammy when the price of oil spikes?
The double whammy is the primary catalyst for emerging market sovereign crises. Let's trace the exact transaction flow. Imagine you are the central bank or a major energy importer in an emerging market. The price of Brent crude just spiked 30% because of severe tensions in the Strait of Hormuz.
Okay.
Step 1. Your baseline energy bill just went up 30%. You need more absolute capital just to acquire the exact same physical volume of oil you needed yesterday.
That's the first whammy.
That's the first. But step 2 is where the financial engineering destroys you. Because that oil is strictly priced in US dollars, you cannot pay the exporter in your local currency, your Turkish lira, your Brazilian real, or your Indian rupee. You have to take your local currency, go into the massive global foreign exchange market, and purchase US dollars first before you can buy the oil.
So simultaneously, every single energy importing nation on the planet is certainly forced to rush into the FX market and aggressively bid for US dollars at the exact same moment.
Yes. The aggregate global demand for the US dollar explodes overnight. And basic market mechanics dictate that when demand for an asset explodes while its supply remains relatively fixed, the price of that asset skyrockets. The US dollar strengthens massively against a basket of almost every other global currency. We see the DXY, the US dollar index, break out to multi-year highs.
And inversely, that means the local currency of the emerging market is in a free fall.
Exactly. As the dollar surges, your local currency depreciates rapidly. So now you are forced to aggressively sell more of your rapidly devaluing local currency just to acquire the same US dollars, which are now more expensive, just to buy the same physical barrel of oil, which is also 30% more expensive.
No.
It mathematically drains the country's foreign exchange reserves. And the collateral damage of that currency depreciation is catastrophic. Because everything else that country imports, pharmaceuticals, agricultural equipment, advanced technology, refined food products, also becomes drastically more expensive in local currency terms.
They are literally importing hyperinflation directly into their domestic economy simply because they're on the wrong side of the dollar equation.
Yes.
But it doesn't just stop at the trade deficit, does it? Because the most toxic vulnerability for emerging markets isn't just importing goods, it's the structure of their national balance sheets.
You're hitting on the core systemic risk that turns an inflation problem into a full-blown sovereign default crisis. Over the last decade of zero interest rate policy, governments and massive corporate conglomerates in emerging markets binged on debt.
Right, cheap money.
And crucially, they didn't borrow in their local currency. They borrowed heavily in US dollars, primarily because dollar-denominated interest rates were historically low and international investors demanded it. There are trillions of dollars in emerging market corporate and sovereign debt denominated in USD.
So they owe their principal and their interest payments in US dollars, but their underlying tax base or their corporate revenue stream is generated entirely in their local, rapidly weakening currency.
Correct. As the dollar acts as a wrecking ball, strengthening relentlessly against everything else, the mathematical cost of servicing that dollar-denominated debt becomes astronomical.
It's an impossible situation.
A government might find that simply making the baseline interest payment on your sovereign bonds suddenly consumes 30 or 40% of their entire national budget, purely because of the currency mismatch. It crushes their fiscal standing, forces draconian domestic austerity, and rapidly pushes vulnerable nations to the brink of sovereign default.
And we've seen this play out.
We've seen this exact dynamic play out recently in places like Sri Lanka and Argentina, where energy shocks and a strong dollar completely break the sovereign balance sheet.
Let me pause you there.
Okay.
I want to analyze how this environment breaks down the traditional rules of macro investing. Historically, wasn't there a very reliable rule of thumb in the FX markets regarding commodities?
There used to be, yeah.
I feel like the conventional wisdom was always that high oil prices were a net positive for the broader commodity complex, and therefore a massive tailwind for the currencies of countries that export commodities. I'm thinking of the Australian dollar, the Canadian dollar, or the Norwegian krone. Didn't a rising tide in oil lift all the commodity currency boats?
That was the foundational playbook for FX traders for 30 years. But you are highlighting one of the most vital characteristics of this new regime, the complete breakdown of historical correlations.
Why did it break?
Well, historically, your assumption was absolutely correct. But why were oil prices rising in those historical examples? They were usually rising because the global economy was booming. China was building massive infrastructure. The U.S. consumer was spending. And global growth was robust.
Right.
That was a classic risk-on environment. In a demand-driven boom, capital flowed freely into all commodities. Copper, iron ore, agricultural products. And so the Canadian dollar and the Australian dollar rallied alongside oil.
Right, because everybody was getting rich and consuming more of everything.
Yeah.
But the scenario we are mapping today is the exact inverse.
Exactly. Remember the distinction we established earlier. The oil spike we are tracking is not a demand-driven boom. It is a fear-driven geopolitical supply shock. It is inherently destructive to global growth.
So it's not a party.
Not at all. When oil spikes because of a threat to the Strait of Hormuz, the market isn't celebrating a booming economy. It is panicking about an impending global recession caused by energy starvation.
It's a risk-off environment.
It is the ultimate risk-off environment. And in a fear-driven supply shock environment, that historical commodity correlation shatters. When the market panics, capital doesn't rationally spread out into Australian copper or Canadian lumber.
Where does it go?
The capital flows bypass the broader commodity complex entirely and concentrate aggressively into the ultimate, undisputed safe haven asset, U.S. dollar-denominated cash and U.S. treasuries. Investors liquidate their foreign holdings and sprint for the safety of the dollar, which only reinforces the dollar's absolute dominance and accelerates the wrecking ball effect on the rest of the global economy.
Okay, so let's tie this entire sequence together. When every sovereign central bank, every multinational corporation, and every macro hedge fund in the world is suddenly frantically scrambling to hoard U.S. dollars, either to pay for their desperately needed energy imports, to service their exploding dollar-denominated debt, or just to hide their capital from the extreme volatility. Those physical dollars have to be sourced from somewhere, which means all of this capital is essentially being vacuumed out of the broader global financial system and locked away. And that brings us to the most opaque, complex, and dangerous phase of this entire deep dive, the liquidity drain and the doom loop.
If we pull back and look at the global macro landscape from 30,000 feet, an oil spike is not just a localized inflation event, and it's not just a foreign exchange adjustment. It is fundamentally, structurally, a massive liquidity drain.
A wealth transfer.
Yes, you are witnessing one of the most violent wealth transfers in the global economy. Capital is forcibly extracted from consuming nations who now have to allocate all their available liquidity just to survive, and transferred over to producing nations. And producing nations tend to hoard that capital rather than immediately reinvesting it into the global growth engine.
Let me try to visualize the mechanics of this liquidity drain, because liquidity can be a very abstract concept for people outside of institutional banking. It feels to me like a giant high-stakes global game of musical chairs.
That's a good way to look at it.
But in this scenario, instead of the music stopping and just taking away one chair, the combination of the central bank hiking interest rates and the oil market hoarding dollars has suddenly removed half the chairs in the room. And those chairs represent the U.S. dollars needed to keep global trade functioning. What actually happens to the institutional players who are left frantically scrambling when the music stops?
It is a chaotic, systemic scramble, and to truly understand how destructive it is, we have to look beneath the surface at the mechanics of the offshore funding markets, specifically the eurodollar market.
The eurodollar market. I've always viewed this as the shadow plumbing of the global economy.
Yeah.
But let's demystify it for everyone listening. Essentially, we are talking about U.S. dollars that are held in banks outside the regulatory jurisdiction of the United States, right?
Broadly, yes. There is a massive multi-trillion-dollar ecosystem of foreign banks, corporations, and shadow financial institutions that lend, borrow, and settle transactions exclusively in U.S. dollars, completely outside the borders of the U.S. This offshore dollar market is the indispensable grease that keeps global trade, supply chains, and cross-border finance moving. But it operates heavily on credit and trust. When the price of oil spikes, the dollar wrecking ball swings, and central banks are tightening, the aggregate demand for those offshore dollars heavily outweighs the supply.
The chairs are gone. The physical dollars have been hoarded or destroyed by central bank tightening.
The chairs are gone. So global dollar liquidity tightens drastically. When liquidity evaporates, the underlying cost of borrowing those dollars in the offshore market skyrockets internationally. We see this in the cross-currency basis swaps and the repo markets blowing out.
Panic sets in.
Banks suddenly become hyper-defensive. They realize there is a global dollar shortage. So they stop lending dollars to other banks. They hoard whatever dollar liquidity they have to protect their own balance sheets. Institutional credit simply dries up.
And when credit dries up at the foundational bank-to-bank level, what happens to the highly visible risk-on assets that everyday investors care about? What happens to the stock market and the corporate bond market?
They experience violent repricing. Equities plummet because the baseline cost of capital is soaring, which mathematically compresses their valuation multiples. While simultaneously, the underlying economic growth expectations are dying due to the energy shock.
So stocks get hit from both sides.
It's a dual-front assault on stock prices. At the same time, corporate credit spreads widen massively.
Meaning the yield gap between the interest rate a fundamentally safe government pays to borrow money and the interest rate a risky corporation pays blows out exponentially. Because suddenly, in a liquidity crisis, no one is willing to take on any counterparty risk. Everyone is terrified of bankruptcy.
Exactly. Risk premiums skyrocket across every asset class. And this extreme tightening of financial conditions brings us to the most terrifying concept in modern macroeconomics, the reflexivity loop.
Reflexivity. This is a concept heavily popularized by George Soros, right?
Yes, it is.
The idea that market participants' biases and actions don't just reflect the underlying fundamentals, but actually change those fundamentals. Walk me through how this loop operates in our scenario.
Reflexivity means the global financial system is no longer just passively reacting to outside geopolitical events. The system's own violent reaction feeds back into itself, fundamentally altering the baseline reality and making the whole structure incredibly fragile and self-destructive.
Okay, connect the dots for me.
Let's trace the exact loop we've meticulously built over the course of this conversation. Geopolitical tension at our physical choke point spikes the price of oil. That higher oil price mathematically creates sticky, second-wave, supply-driven inflation.
Right.
That unyielding inflation forces central banks into a straitjacket, compelling them to hike interest rates and tighten monetary policy. That severe tightening creates a massively strong wrecking ball U.S. dollar. That dominant dollar drains global liquidity and crushes emerging markets. And that drained liquidity creates extreme market volatility, credit contraction, and severe economic pain.
Okay, I have followed all of that perfectly. That is the linear chain reaction, but a loop has to close. Where is the feedback mechanism?
Yeah. The kicker is what happens as a direct consequence of that economic pain. That resulting extreme market volatility, capital flight, and domestic economic suffering feeds right back into policymaker panic and, crucially, geopolitical instability.
Oh, wow.
When emerging market populations can't afford food or energy because of the dollar wrecking ball, you get civil unrest, governments fall, regimes get desperate. Supply chains break down even further due to the chaos. Nations begin weaponizing their natural resources to maintain leverage.
So the pain creates more conflict.
And that results in global instability, starts the cycle all over again, feeding right back into the initial geopolitical tensions at our physical choke points, but this time with amplified intensity and even less systemic liquidity to absorb the shock. It is a closed, self-reinforcing doom loop.
Okay, let's take a deep breath and take a step back here. I am looking at this entire, highly complex macroeconomic map we've drawn over the last hour. If this loop is genuinely self-reinforcing, and if traditional central bank monetary policy is structurally useless against a physical supply shock, then the old rulebook of the global economy, the playbook investors have used since the 1990s, isn't just slightly outdated, it's completely dead. We are officially operating in a fundamentally new regime.
You have articulated the exact thesis that institutional allocators are struggling to accept right now. We have to officially define this era as the new oil regime.
The new oil regime.
Yes, for 40 years we operated under a highly recognizable paradigm. The old commodity cycles were defined by periods of massive capital investment leading to oversupply, eventually followed by demand-driven fluctuations. If prices got too high, a new technology like shale drilling was funded, producers drilled more oil, flooded the market, and prices normalized.
It was a cyclical, rational economic process driven by the cost of capital in free markets.
Right. But that elasticity, that capital responsiveness is over.
It's permanently over.
It is permanently over. We have shifted to a new, rigid baseline. The defining characteristics of this new regime are structural supply tightness, severe ideological and financial constraints on new capital production, and deep, unresolvable geopolitical fragmentation. The flexibility and the slack have been completely expunged from the system.
Okay, so here is the ultimate so what for you listening to this deep dive right now. If I am an everyday investor trying to manage my 401k or retirement account, or if I'm a corporate treasurer trying to plan inventory for the next 5 years, or honestly, just someone trying to protect the purchasing power of my hard-earned savings, how do I navigate a financial world where this extreme reflexivity-driven volatility isn't just a rare once-in-a-decade tail risk anymore, but is actually the permanent structural baseline?
The very first intellectual hurdle you have to clear is accepting that traditional portfolio diversification strategies are fundamentally broken in this regime.
You mean the classic 60-40 portfolio, the bedrock of modern retirement planning. 60% allocated to equities for growth, 40% allocated to government bonds for safety.
That's the one.
The entire premise being that when risk-on stocks go down during a recession, risk-off bonds will go up in value and protect your portfolio's downside.
Exactly. That strategy was the holy grail, and it worked brilliantly in the old regime of demand-driven economic cycles and stable inflation. But in this new regime, the math fundamentally fails.
Why?
Because during a global liquidity drain caused by a supply-driven inflation shock, the correlation between stocks and bonds flips from negative to positive. Assets that historically hedged against each other now move down in tandem.
Oh, man.
When inflation runs hot and central banks are forced to hike rates, the discount rate on future corporate earnings goes up, crushing equity valuations. Simultaneously, those rising interest rates mechanically crush the price of existing bonds. There is nowhere to hide in traditional paper assets. Your equities bleed, and your safe haven bonds bleed at the exact same time.
So what is the actual paradigm shift for the listener? How do they need to aggressively rewire their brain to understand and survive the markets today?
The paradigm shift requires recognizing the new elevated role of physical commodities, specifically oil. Oil is no longer just a standard commodity that reflects underlying macroeconomic conditions.
Right.
In the old regime, you looked at the price of oil as a lagging indicator to guess how well the global manufacturing economy was doing. Today, oil is a strategic, heavily weaponized geopolitical asset that actively shapes macroeconomic conditions.
It's the driver of the car, not just the speedometer.
It is the engine, the steering wheel, and the brakes. It sits entirely upstream of everything else we care about in the financial world. The physical flow of energy is upstream of central bank interest rates. It is upstream of foreign exchange currency values. It is upstream of structural inflation.
So it's everything.
Understanding the deep mechanics of the energy market, recognizing the fragility of these geographical choke points, is no longer just a niche, specialized trade for commodity brokers in Geneva or Houston. It is the absolute prerequisite for understanding everything else in your financial life.
Okay, let's comprehensively recap this incredible, complex journey we've been on for the listener, because we have covered a massive amount of institutional ground today.
We really have.
We started by visualizing a wildly congested, incredibly narrow shipping lane in the Middle East. We traced how the fundamental inelasticity of modern energy markets, compounded by a decade of severe capital underinvestment, means a tiny physical disruption at that choke point creates a massive asymmetrical price spike, We tracked that oil spike as it morphed into a sticky second wave, supply-driven inflation virus that infected agricultural fertilizer, industrial manufacturing, and wage expectations. We watched as that structural inflation trapped powerful central banks in a policy straitjacket, forcing them into a no-win scenario between crushing the domestic economy or losing their institutional credibility in the bond markets.
Yeah.
We saw how that dynamic unleashed the U.S. dollar as a global wrecking ball, devastating emerging market currencies and blowing up dollar-denominated sovereign debt. And finally, we saw how that frantic global scrambling for dollars violently drained offshore market liquidity, kicking off a self-reinforcing reflexivity loop that completely defines our new, highly volatile macroeconomic reality.
It is a profound, relentless chain reaction.
Yeah.
And tracing the mechanics of it step by step, removing the emotion and looking purely at the institutional plumbing is really the only way to truly comprehend the extreme fragility of the current system.
Which brings us to the end of our deep dive today. But before we wrap up, you always have a unique way of looking at the entire macroeconomic chessboard and seeing the underlying power dynamic that nobody else is talking about.
Well, I try.
Based on everything we just mapped out, the failure of traditional central banking against physical supply shocks, the weaponization of energy, what is the final unspoken implication here? What is the provocative, paradigm-shifting thought you want to leave the listener to chew on?
If we logically accept the reality of everything we've discussed today, if we accept that physical energy choke points and structural supply deficits now dictate global inflation, sovereign interest rates, and systemic liquidity far more effectively than any academic monetary policy, this raises an incredibly important, almost deeply uncomfortable question about the true nature of global authority.
What's the question?
Well, for the last 40 years, the market has implicitly assumed that the ultimate power over the global economy resided with men in tailored suits sitting in mahogany boardrooms at the Federal Reserve in Washington or the ECB in Frankfurt. We believed they controlled the levers of the machine.
Right, the masters of the universe.
But if they mathematically cannot print physical oil and their monetary tools are impotent against a geopolitical supply shock, has the ultimate foundational power over the global financial system permanently shifted away from Western central bankers and back into the hands of the geopolitical actors who control the physical flow of commodities through the world's narrowest waterways?
Wow, the illusion of control. Has the true center of macroeconomic gravity shifted from the sterile boardroom in Washington to the muddy, congested choke point in the Middle East? That completely changes how you read every single headline, every central bank press conference, and every geopolitical flashpoint. Thank you for bringing your incredible institutional depth to this conversation, and thank you, the listener, for joining us on this deep dive.
It was a pleasure.
Our goal today was to help you see the matrix, to understand the hidden, complex plumbing beneath the surface of the daily news cycle. So the next time you picture that tiny, narrow waterway on the map, or see a blurb about a shipping delay, remember the unstoppable chain reaction it holds. Keep questioning the headlines. Keep looking for the underlying mechanical truth, and we will catch you on the next one.